You see those headlines, right? Some company buys another for a mind-boggling amount of money. And you gotta wonder, how do they even come up with that price? Well, today, we're gonna pull back the curtain. We're gonna decode the three magic words that get thrown around to justify these astronomical deals.
I mean, that's the real mystery, isn't it? A company is trading on the stock market for one price, and another company swoops in and says, nope, we're going to pay 20, 30, maybe even 50% more than that. That extra bit, that's the premium. And we're talking billions of dollars. So where does that money, that value, actually come from? Is it real? Or is it just, corporate wishful thinking? Well, it turns out that in the world of high finance, they have three big, shiny buzzwords they love to use. I like to call them ornaments that they hang on these deals to make them look good: synergy, control, and complexity. They sound super impressive, right? But what do they actually mean? Let's break them down. Okay, so here's our game plan for today. We're going to start by deconstructing synergy. Then we'll get into calculating control. And finally, we'll tackle the surprising price of complexity. All right, first up is the big one, synergy. You hear this word all the time when companies merge. It's this almost magical idea that 1 + 1 can somehow equal 3. But the real question is it a real, tangible thing you can put a price on? Or is it just a nice story they tell to make the deal sound better than it is? So, the basic definition is simple enough. It's the idea that two companies combined are worth more than the sum of their parts. But here's the cynical view, which honestly is often the truth. Imagine a banker values a company at, say, $100 million. But to actually buy it, they have to offer $150 million. So what do? That extra $50 million? Poof. They label it synergy. It becomes what's known as a plug variable, just a number you stick in to make the math work. Now, to be fair, synergy can be a real thing. It's not always just a fudge factor. It usually comes in two flavors. You've got operating synergy. This is the classic stuff you think of, like cutting costs by getting rid of duplicate departments, or creating new ways to grow by combining sales teams. And then there's financial synergy. This one's a bit more behind the scenes. Think tax benefits, or the fact that a bigger, combined company can borrow money more cheaply. And here's the really interesting part. Synergy isn't just some vague, fluffy concept. You can actually calculate it. The process is pretty simple, really. Step 1. Figure out what the acquiring company and the target company are worth all by themselves. Step 2, just add those two numbers together. That's your baseline. Then, step 3, you value the combined company. But this time, you bake in all those potential synergies, the cost savings, the new growth, all of it. The difference between that new number and your baseline, bam, that's the theoretical value of synergy. Okay, so let's put this to the test with a real-world, absolutely massive example. You probably remember this one when Procter & Gamble, the people who make basically everything in your house from Tide to Crest, decided to buy Gillette. And you can bet the air was just buzzing with talk of, wow, you guessed it, synergy. So, the analysts got to work. They ran the numbers using that exact three-step process we just talked about. They took every single promise management made, every single cost cut, every potential new market, and they assumed it would all work out perfectly like magic. This absolute best case, everything goes right scenario put the value of synergy at $17 billion. I mean, that's a massive number, right? But wait for it. Here's the kicker. The premium P&G actually paid for Gillette was $25 billion. Let that sink in. Even if every single thing went perfectly, the synergy was only worth $17 billion. That means they overpaid by at least $8 billion. And that right there is the danger. Synergy can be real, but it's so easy to get swept up in the story and pay way more than it's ever going to be worth. Okay, let's move on to our second ornament, control. Now, you often hear people talk about a standard control premium, like it's a fixed thing, 20% or 25% just for taking over. But that's not really how it works. The value of control isn't some fixed number. It's all about how much better you think you can run the company. Yeah, this quote from Professor Demodaran just nails it. Think about it. If you take over a company that's already perfectly managed, what are you going to do? There's no room for improvement. It's already firing on all cylinders. In that case, the value of control is, well, it's zero. The value only exists if you can actually make things better. So how do you actually calculate this? Well, it's basically a story of two different values. On one hand, you have the status quo value. That's what the company is worth right now
as is, with its current management team just chugging along. Then, you have the optimal value. This is what the company could be worth if it were run perfectly, if you came in and made all the right moves. And the formula is so simple, but it's really powerful. The value of control is just the optimal value, minus the status quo value. That difference, that gap between what is and what could be, that is the value of control. That's the potential you're paying for. And you can actually see this concept in action in the stock market. Ever wonder why, for some companies, the shares that have voting rights trade for more than the non-voting shares? It's this exact principle. If you have non-voting shares, you're just along for the ride with current management. You're stuck with the status quo. But if you have voting shares, you have a voice, a chance to push for changes and unlock that optimal value. So the worse a company is being run, the bigger that gap, and the more valuable those voting shares become. Okay, that brings us to our third and final ornament, and this one is really fascinating because it's kind of counterintuitive. It's complexity. We tend to think of complexity as just a thing. Big companies are complicated, right? No big deal. But it turns out the market doesn't see it that way at all. There's a hidden and very real penalty for being hard to understand. Just picture this for a second. You've got two companies. On paper, they are identical. Same profits, same growth, same cash flow. But company A is simple. It does one thing, has a clear structure, easy to read financial statements. Company B, on the other hand, is a mess. It's got businesses all over the place, a crazy holding structure, and accounting that's impossible to follow. Which one would you rather invest in? Exactly. Everyone picks the simple one. Why? Because complexity breeds uncertainty. And if there's one thing investors hate, it's uncertainty. They're afraid of what might be hiding in that mess. All right, so that makes perfect sense, intuitively. But this is finance, and we need to put a number on things. So if the market is really penalizing companies for being complex, how in the world could you possibly measure something so abstract? Well, the answer is so simple, it's almost funny. One of the best ways to get a handle on a company's complexity is to just count the number of pages in its annual report. That's the big 10K filing they have to do every year. The logic is pretty solid, right? If it takes you hundreds upon hundreds of pages just to explain what your business did last year, chances are you're a pretty complex company. And get this, when you actually run a regression on this, the data is crystal clear. An analysis found that for every additional 100 pages in a company's annual report, its price-to-book ratio, which is a way of measuring its market value against its physical assets, drops by about 0.3. That's a direct, measurable penalty. The market is literally saying, you're too complicated, so you're worth less to me. So let's wrap this up with our key takeaways for these three big ornaments. First, synergy. It can be valuable for sure, but you absolutely have to calculate it because it's so easy to overpay. Second, control. Its value isn't a flat fee. It's the difference between a company's current reality and its future potential. And finally, complexity. It's not just a nuisance. The market puts a real, measurable discount on companies that are too hard to understand. So the next time you see one of those big merger announcements and you hear the CEO on TV talking about all the incredible synergies they're going to create, maybe you'll be a little more skeptical. And maybe, just maybe, you'll be the one thinking, okay, but can you show me the numbers?